The stock market is a device for transferring money from the impatient to the patient. Warren Buffett said that. But right now, the market isn't transferring money from the impatient to the patient. It's transferring money from everyone else to 7 companies. 7. Out of over 4,000 stocks listed in the United States, 7 companies now make up roughly 33% of the entire S&P 500. To put that in perspective, that's like walking into a class of 30 students, and 2 kids are doing 33% of the homework for everyone. And somehow, their grades determine your grade. That's the market you're investing in right now. So today, we're going to answer the question nobody on CNBC wants to sit with. What happens to your money when 7 stocks sneeze, and the rest of the market catches pneumonia? Let's rewind, because this isn't the first time the market got dangerously cozy with a handful of names. 1929. The Nifty 9, American Can, GE, RCA, and a few others dominated market sentiment. Everyone piled in. These are the future. These can't go down. They went down. Hard. 89% in 3 years. Fast forward to the late 1990s. Cisco, Microsoft, Intel, Lucent, the original tech lords. Cisco alone hit a market cap of $555 billion in March of 2000. Everyone said, these companies are the economy now. Then the Nasdaq fell 78% in 2 years. This pattern has a name. Economists call it market concentration risk. You can call it what it really is, putting all your eggs in 7 very expensive baskets. Now, here's the twist. Unlike 1929 or 1999, these 7 companies actually make money, obscene amounts of it. And that's what makes this story so much harder to read. Because this time, the bubble, if it is one, has a heartbeat. Okay, let's talk numbers. Real ones. The Magnificent 7. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla collectively carry a market cap north of $16 trillion as of early 2025. That's larger than the entire GDP of every country in the world, except the United States and China. 7 companies. Bigger than Japan, Germany, India, and the UK. Combined. Let that sink in. Now here's where it gets uncomfortable. The average price-to-earnings ratio of the Magnificent 7, sitting around 40 to 55 times earnings, depending on the name. Nvidia? At its peak, it was trading at over 70 times forward earnings. The S&P 500's historical average PE, around 16 times. That means investors are paying 3 times the historical premium, betting that these companies will grow into their valuations. Maybe they will. Maybe they won't. But here's the part that keeps fund managers up at night. Because these 7 stocks are so heavily weighted in index funds, your boring, safe, diversified index fund, when these 7 names sell off, your index fund sells off with them. In 2022, when the Fed started hiking rates, the Magnificent 7 lost a combined $4.6 trillion in market cap. That wasn't just bad news for tech bros. That was your 401k, your IRA, your grandma's retirement account. Because passive investing, the strategy everyone told you was the smart play, quietly made you a hostage to 7 stocks. So what does this actually mean for you right now in the real world? Here's the honest answer. It means your risk is more concentrated than you think. If you've got a standard S&P 500 index fund, congratulations, you technically own 500 companies. But in reality, about 1/3 of your money's fate is tied to a handful of executives in Cupertino, Redmond, and Santa Clara. That's not diversification. That's an illusion of diversification with extra steps. Now, before you panic and move everything to gold, here's the other side. These 7 companies generated a combined $1.7 trillion in revenue in 2024. NVIDIA's data center revenue alone grew 217% year over year. Microsoft's cloud arm, Azure, is growing at 28 to 30% annually. These are not ghost companies with zero revenue and a dream like Pets.com. They are cash machines. But here's the philosophical question you should be sitting with. Can they keep growing fast enough to justify prices this high? Because the math only works if they do. If Microsoft grows at 12% a year instead of 18%, if NVIDIA faces real competition from AMD or from custom chips made by Amazon and Google themselves, the whole tower doesn't have to fall to hurt you. It just has to wobble. So here's where we land. The Magnificent Seven are not villains. They built real things. They changed the world. They made a lot of people genuinely wealthy. But the market has a long, ugly history of falling in love too hard, holding too long, and paying too much. And right now, the market is in a very serious relationship with 7 companies. So what should you actually do with this information? 1. Know what you own. If you're in an S&P 500 index fund, understand that you are meaningfully exposed to these 7 names. That's not a reason to sell. It's a reason to be aware. 2. Consider diversification beyond U.S. large caps. International stocks, small caps, and value stocks are all currently trading at historically cheaper valuations. You don't have to abandon the 7, just don't only own the 7. 3. Don't bet the farm on a thesis, not on doom, not on hype. The future is genuinely uncertain. Anyone who tells you otherwise is selling something. The market isn't rational, it's emotional. And right now, it's feeling very, very confident. History's last words to confidence? Hold my beer. If you found this useful, subscribe. We make complex finance feel like a story every single week.